Dustin, so good to see you. Today, we're going to talk about why DIY investors earn less. A lot of investors are choosing a do it yourself approach, managing their own portfolios, picking their own investments, and trying to avoid advisory fees. But while that may sound like a cost saving strategy, the data tells a very different story. So, today, we're going to take a closer look at why DIY investors often earn less. So let's circle back to DIY investors believing they can save money by avoiding advisory fees. Is that really true?
Oftentimes, Aaron, it's not true. And the reason for that is a good advisor can add value beyond the investment returns themselves. Now, that's not something you have to take my word for. We could go to, for example, the researchers at Vanguard, because Vanguard did an amazing study called Advisor Alpha. And what they found, Aaron, was that a good advisor can add up to 3% in net returns per year. So I've asked Nick Manley, a market director at Vanguard, to join us and talk about that study.
Yeah, Nick, thank you for being with us today. We appreciate it.
Happy to be here. Thanks for having me.
Yeah, so let's start with that Advisors Alpha study that Dustin mentioned here. I want to talk through what we're looking at. Again, sorry, my buttons are a little bit slow this morning. This study is a really close, in-depth look at how a good financial advisor can add, again, 3% in net returns per year through behavioral coaching, asset allocation, rebalancing, and tax planning. Can you explain the difference in this performance gap?
Yeah, of course. Thanks, Aaron. Vanguard is the second largest money manager in the world, and we're known for offering low-cost funds to investors. What may surprise some of our listeners, though, is that do-it-yourselfers only account for about a quarter of our business as it stands here in 2026. Today, about half our assets under management are held through financial advisors like Dustin and his team. We started seeing this shift about 25 years ago, and so we wanted to know why. We started doing research into it, and we found that investors had better outcomes when they took the advice of a real financial advisor. Now, by helping investors with things like putting the right assets in the right accounts, withdrawing in the right order, building efficient portfolios, rebalancing them on a regular schedule, you do all this together, and advisors tend to outperform do-it-yourselfers by 3% a year. That was the big takeaway from the Advisors Alpha study.
Yeah, Nick, thank you. That is such a significant number, Dustin, when we think of it, especially cumulatively. What I'm hearing as Nick mentions all of this is the importance of having a plan, right? And when you have that plan, you are more likely to stick with it and not succumb to the vagaries of emotional investing, which is something we've talked about many times. Explain that, though, for our viewers today, please, Dustin.
Sure. So this is just something that a lot of do-it-yourself investors fall prey to. It's a natural emotional cycle. You know, I can't tell you how many times I've heard investors talking about wanting to sit on the sidelines in cash until they feel comfortable investing again. The problem is markets are forward looking. So by the time that they feel comfortable investing again, those markets have recovered and they're buying back in at higher share prices. You know, also we tend to, it's not just fear of the market, it's fear of missing out. You know, a lot of people tend to make poor investment decisions at the top of markets when markets are frothy, chasing things that have had recent high returns when they should be rebalancing that portfolio and taking some of those profits and some of that risk off of the table. Mm-hmm. That's just one area where an advisor can add some value, help that investor work off of a plan that can be, relatively evergreen, a plan that fits their time horizon, their risk tolerance, and a plan with some risk management in it, so that advisor can be more comfortable going through those ups and downs. Maybe we can remove some of the volatility to smooth out the ride, for example.
Right, really important. And I think what's great with the Advisors Alpha study that you had, Nick, was a real world example of this in motion during COVID. Can you explain what we're looking at here, please?
Yeah, of course. I mean, look, at its core, behavioral coaching is making sure investors have an unemotional sounding board, someone like Dustin and his team, to help with these decisions during market volatility or dislocations, to help them make smart decisions. Because it's hard to do it yourself when you're in the midst of something like the COVID crisis. I mean, even I use a financial advisor for that reason. And so this is a great example. It's kind of in our recent memories here. If you started the year in a diversified portfolio with $1 million back in 2020 and started to get scared when the virus hit in March and decided to raise cash or de-risk, at the end of the year, you would have been in really bad shape. Like Dustin said, markets are forward-looking. And if you had waited to have good news around a vaccine, you would have already missed the market recovery. So if you had just stuck with your plan through the ups and downs of the year, you would have ended the year in a profit. You would have been close to $1.1 million off that
Right.
1 million. It would have been a bumpy ride, but it doesn't mean we have to sit in our hands during that bumpy ride. So things that advisors like Dustin can do during volatility are tax loss harvesting, rebalancing, reevaluating the strategies and the plans, making sure we have the right low cost, efficient funds in the lineup. The market gives us these opportunities from time to time, and it's advisors like Dustin and his team that can take them. So as you can see here, behavioral coaching is super important alongside all those other things we talked about earlier. Altogether, that's what encompasses the 3% or more a year that advisors add that the study found.
Yeah, it's so interesting when you get to see the data behind it. Nick, I appreciate that visual very much. And Dustin, I think this goes back to something that I've said to you before. If your advisor is just talking about your investments, it's time for a new advisor. But for somebody who is thinking of hiring an advisor, Dustin, what is the best way to start the conversation to determine if they should, and what should they expect in that first conversation?
Sure. So first of all, I think if somebody recognizes the value a good advisor can add beyond the investment returns, I think they're a great candidate for having those conversations and that kind of a relationship. To start that conversation, the best thing they can do is share with that advisor their concerns. Share with that advisor what's worrying them, what they're struggling with. That's much more important information to me than, seeing somebody's account statements. And what they should expect in that first meeting is they should expect an advisor who asks questions and listens intently. During the first meeting, the client should expect to do most of the talking.
Right. That's a really important distinction. This was a lot of fun to talk this through. And just to let everybody who's watching know, we will include a link to this study. So if you want to pour yourself a cup of coffee and kind of go through it yourself, it really is an interesting look at how we as humans tend to make emotional decisions as opposed to decisions based on data. But Dustin, if somebody would like to sit down with you, create that financial plan with you, what's the best way to reach you?
Yeah, they can give us a text or a call at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
All right. Nick, Dustin, thank you both for your time today. I appreciate it.
Thanks, guys.
Thank you, Aaron.